Good afternoon, everyone. My name is Art Alvarez with MortgageWorks, where we have the answers and they're on the house. Welcome to this week's Mortgage Minute. Coming to you from actually today, a pretty cool and rainy Palm Springs and the greater Coachella Valley area. We've definitely had some weather here in Southern California at large for the last few days. More rain, and of course, that's always needed to keep our drought in check. Finishing up here locally, we got a lot going on. A lot of people in town for the what is often called the fifth Grand Slam, the fifth major. I'm referring to tennis, the BNP Paribas Open. We're winding down to the last weekend where we're going to have the finals on Saturday for the women and Sunday on the men's side. So again, a lot going on here locally. And so I want to go ahead and start off the show with what we usually do, which is giving you an interest rate, mortgage interest rate, and bond market update. And it's been a wild week in the financial markets, which I'll go into a little bit here right now. First of all, as to rates, they're hanging in there pretty good. It's getting to be kind of a boring, redundant message, but rates are kind of pretty stable. We're still in the sixes. Again, a little bit uptick from a week or so ago. We're more closer to the mid sixes than we were last week, and you can see that there on the screen. Still very good overall. Stability in the mortgage rate market is what I think is the current buzzword, and that's a good thing. I think the more stability we have with mortgage rates, I think that's better for both bringing out more home buyers and maybe getting some of those homeowners with the tremendous amount of equity that they have to consider taking advantage of that. By looking at borrowing some money, whether it's a new cash out first mortgage, which isn't happening too much, but or certainly the equity lending side, there's a lot of opportunity there. But you can see on the rate grid, 6 3/8 is the kind of the going rate for 30-year fixed for a conforming loan. The buy downs, of course, 3.21 and 2.1 get you in the threes or fours. FHA and VA are still looking pretty good in the high fives. And even the jumbo's looking very good. Look at that 7/1 ARM jumbo loan, 6 1/8. So again, I think generally good news despite all the volatility in the financial markets this week. Jeff's going to pull up the 10-year bond chart, and actually we had some late improvement today, as you can see from that chart. And this is a 5-day chart, goes back to last Friday. Last Friday were about at the level we're at now, finishing up today. It kind of blipped up a little bit early this week, Monday, then started dropping down to a pretty low point, under 4.2 on Tuesday. So that was a Tuesday dip, not the usual Wednesday dip that Jeff usually hopes to see, and that's his theory that Wednesdays when we see the dips. This week it's a little early; it was on Tuesday, but then you saw the bond yield climbing up the rest of the week. And then again, kind of midday today, we kind of dropped back down. Early today, the 10-year bond yield was actually up around 433, almost got to 434. So it's nice to see finishing up the day at 427. And again, there's been a lot of volatility, not so much with the bond yields. I think this chart is relatively stable in the sense that the spread has not been that wide. But certainly, many of you may know, the stock market's been all over the place, and it's been generally down for most days, including today. I think last I checked, it was down about 500 points. So let's talk about a couple of things that are contributing to where bond yields are. The first thing I want to mention to you is recession talk. It's back in the news. There's lots and lots of hand-wringing that recession is suddenly on the horizon. There's really two reasons for that. One is there was a decline in consumer spending in January, 0.2%. So that got the attention of the markets, considering that maybe an early clue that a recession is coming, that consumer spending is starting to back off. Because again, consumer spending has been very strong throughout the most recent period, really going back several months, even a year or two. And again, the U.S. economy is about almost 70% service-based, and consumer spending has been strong throughout. And so January was the first sign of a decline, and 0.2% was considered a pretty strong decline. In fact, I think the biggest decline in almost 4 years. So that certainly contributed. And then the other couple of things this week, this week is inflation week. We had the CPI, that's the Consumer Price Index, came out yesterday. And then today we had the PPI, the Producer Price Index, that's inflation at a wholesale level, that came out today. Both were forecast to be flat or slightly down, and that proved to be true. That is what the new numbers this week reflected. However, if you pull out food and energy to get the core CPI and PPI, there was a slight uptick. So what's going on here is we've got some, data points here that are definitely kind of getting the market's attention. In the bond yield side, now the recession talk you would think would normally help the bond yields, because unfortunately in the mortgage business, we've said before on the show some time ago, a bad economy is generally good for mortgage rates. That tends to bring bond yields down. So this early recession talk hasn't really helped the bond market that much in that regard. And why is that? And why is it that the CPI and the PPI numbers coming in as expected didn't help push the bond yields down even further? Well, it's all the tariff talk, the Trump tariff talk. That's got the markets a little bit jittery. There is a big concern that the tariffs could be a combination of recessionary because of the fact that these tariffs could cause some job loss. And of course, then you've got the whole Doge thing going on in the federal government with people being let go. That could add to unemployment. And of course, more people unemployed is going to affect spending. So that's part of the reason recession's back in the discussion. But at the same time, the tariffs or the concern about tariffs is also a concern about causing inflation to go up because of the prices of goods and services increasing because of the tariffs. But the issue here is those numbers haven't borne out in the data points yet because it's too early. So what's really going to be interesting is if we go into March and April and further into the year to see if all this tariff talk and activity really is going to percolate through to the actual data points where we might see some maybe increases on unemployment, which could, of course, be part of the recession talk. But at the same time, will the tariffs, if they're in place for any length of time, would that start to affect prices on goods and services, which, of course, could cause inflation to creep up a little bit? So I think overall, the bond market's not quite ready to embrace the good news of the lower inflation numbers out of fear that they're about to get worse because of the tariffs. I'm not sure what to suggest in terms of the tariff issue at large. I tend to believe it's still more of a negotiating process, and that eventually, us and the other countries will all get in a room, get at a table, and work this out to maybe these tariffs don't end up being as significant as feared. And if that turns out to be the case, then hopefully that will mean we'll start to get back to the more fundamentals in terms of data points that suggest that inflation is getting more under control. So we'll see what happens. There's no other data points of this week, like for tomorrow, of consequence. So we'll see what happens next week in that round of data points as to the effect on the bond market. So with that, I'm going to bring Jeff in because we're going to talk about kind of a niche segment of the mortgage industry that is very, very, I'll say, popular within the industry among lenders. And so Jeff and I are going to talk about it right now. Hi, Jeff.
Hey, Art, how you doing?
Doing pretty good. How are you?
Good. I would like it if I was looking out the window and seeing blue sky versus hearing rain hit on the window. But I'm grateful for the rain. We need it.
We
always,
do.
Right?
We do. We just need to do a better job of capturing that water and storing it. So
that's it. I feel sorry for the tennis players here and all those people who came in. But it's that little blip on the screen that normally doesn't hang around long. So.
Exactly, especially out here. Yeah.
Hey, I'm excited to talk about today's topic because it involves a group of people that I know you call them the non-qualified or non-QM type of people. And I think it goes beyond. It says, I'm self-employed. Can I still buy a house? I know it's a challenge. My wife and I just kind of went through this process with you, and thank goodness we got through it. But there seems to be more to that. And really, I just want to, if I could, I just like to ask you a few questions about that.
Oh, absolutely. Yeah. Yeah. There's a lot in that area that we could talk about that I think folks will find very interesting.
Well, the first one, and I kind of already let the cat out of the bag, is what if I'm not a W-2 employee? What do you call those people?
Well, it's interesting because historically, borrower profiles in terms of employment and income generally are going to have been two profiles. The W-2 employee, or what we call in the industry a wage earner, and then self-employed borrowers. So that's been sort of historically the two major borrower profiles. And in the old days, not too long ago, back before the big real estate and mortgage crash of '08, where the self-employed borrowers were serviced or served mostly was with what we used to call stated income loans, or no income, no asset loans, even where we would not verify income or their assets. So that developed, again, many, 20 plus years ago, to help serve that self-employed borrower who wasn't able to get mortgage financing because they didn't meet the underwriting criteria to get approved for a conforming loan. And the fundamental issue about that was when you're self-employed, you're not qualified based on the gross revenue of your business. That's unlike a wage earner. When you're a wage earner or a W-2 employee, you are qualified based on your gross income from your job, whether it's a fixed salary or if you're hourly or if you're a salary or hourly with bonus and commission, which all that, the bonus or commission variable components have to be average. But overall, you will be qualified based on your gross income as a wage earner. And when I say qualify, what I mean is your gross income will be used to calculate a debt ratio based on your verified monthly stable income. And that's been the case now since 2010, after the big crash, where the new ability to repay rules were put in place by the CFPB. So that pretty much meant that the stated incomes, or the no income verification loans that were done prior to that, were no longer available. So with a wage earner, it's pretty simple. Gross income, we figure out what the monthly average stable amount is, add your other debts and your projected housing expense, we calculate your debt ratio, and that'll determine if you qualify. But for the other borrowers, the self-employed generally speaking, but the broader now term of a non-QM borrower, what that means is non-QM, non-qualified mortgage. So you're not able to qualify for the underwriting guidelines published by the federal agencies, Fannie Mae, Freddie Mac. So we had to come up with a new set of rules essentially to get those kind of borrowers qualified. And again, the historical challenge with self-employed is you're not qualified on your gross, but on your net. There's a fundamental direct conflict between when you're self-employed and when you're deciding how you're going to report your income for tax purposes, how that can conflict with these rules for calculating a debt ratio based on your recurring monthly income, because we have to use your net, not your gross. Well, most self-employed borrowers, probably on the advice of their accountant, generally tend to be pretty aggressive on declaring expenses against their gross revenue from their business, and therefore report a very low net income. The benefit to that, they pay less federal income tax or state income tax if there is state income tax like in our state. But that's a problem if you're trying to qualify for a mortgage and meet a debt ratio requirement, because since we have to use that lower net income figure, and if it's substantially below your gross revenue, in a lot of cases, it undermines your ability to qualify for a mortgage. So there's a direct conflict between the two. And so, again, I keep referring to the old days in the early 2000s before the crash, stated income loans in general would address that issue, where the self-employed borrower would be able to basically state their income, and they would tend to state it based more on their gross than not their net, and that would be a way to get qualified. Well, with that going away, the industry had to develop sort of a new approach to get those borrowers qualified, and that's where this non-QM, non-qualified mortgage segment came up. And again, the core profile was self-employed, but it's now broadened to more borrower types than just the traditional core self-employed borrower. And that's what we can talk more about.
Let's talk about the, who are these borrowers, because
Mm-hmm.
I, as you mentioned, back in 2004 through about 2010 or 11, I fell into one of these, and then when I started my company, which we have now, I'm still one of these, but I actually do get a W-2, but because I own the business, it's kind of complicated. But let's talk about who these people are. I think the first one you mentioned was business owners, right?
Right, exactly. Business owners, which of course is part of that self-employed borrower profile. And the issue with business owners, you've got different types. A business owner, oftentimes, if it's a small business, particularly a sole proprietorship, then most likely they're not even incorporated. They likely file a Schedule C with their tax return. That document, that form in your tax return, profit or loss from business or profession. So that gets used to qualify you. But again, you have that same problem of we can't use the gross, we have to use the net. And in most cases, a business owner who is a sole proprietor filing a Schedule C, almost always there's no salary they're paying themselves. So it's all based on, what is that bottom line net profit? And again, because they tend to be aggressive to avoid income tax, that bottom line usually is going to be too low to get you qualified. Now, in some cases, a business owner, even if it's a small business, may have incorporated, most commonly an S corp, where they may have a salary they're paying themselves, and so we can use that, and we can use the gross amount, but we still then add to that the net. And again, the problem is the net income generally tends to be too low, and in many cases they can't meet the debt ratio. So that's one of the types, but there's others. Another term you hear a lot about is people who are gig workers or they're freelance workers. And yeah, here's a couple of good examples. Uber drivers. That's a common type of borrower profile now that we see. Those people tend to be paid not on a W-2 salary basis, right? Obviously, and so can be challenging to get them qualified. Another borrower profile that is pretty common, and I think actually is a type of borrower profile that is a major component of non-QM loan programs, is real estate investors. Um, there are people out there who own several rental properties, and they can have trouble getting qualified for conforming loans because, again, with them, they're going to have Schedule E that'll list their rental property or properties, and they may have a lot of expenses they're declaring against the rental income from those properties, arriving at a net income that, even when we can add back the depreciation for the property itself, the resulting amount is too low to get them qualified for the conforming debt ratio requirement, the ability to repay requirement. So that part of the non-QM space is the real estate investor is a big part of the non-QM space. In fact, a specific loan program that's used for them is what we call DSCR, debt service coverage ratio, where for a real estate investor, you're qualified solely on what's the mortgage payment that is going to result from the loan amount you want, compare it to the rental income. If it's a break even or better, that's how you're qualified. You provide no other documentation at all, including if you have a job, that's left off the application entirely. You don't put down your employment. You don't put down your employment income. It's simply, is it break even or better? If so, you're going to get approved solely on that. Another common scenario for a non-QM borrower is someone who may have a job. Maybe they don't earn a whole lot of money in that job, or maybe they're recently retired, but they got a lot of money in the bank. This can be the type of borrower that we will use a non-QM program for. In this case, it's typically referred to as asset utilization, where what we can do is take the amount of money they have in the bank, and this can include, by the way, regular checking and savings and investment accounts like stock, mutual funds, and even retirement accounts. And if they're looking to buy a home, but their recurring monthly income is too low to qualify for conforming debt ratio, we can calculate basically an assumed monthly income amount by first deducting from the grand total of all these liquid assets, deduct the amount of money they're going to need to buy the home, and take that remaining amount and essentially amortize it over some period of time. Now, on a conforming loan side, asset utilization is available, but it's more conservative. We have to take the total asset amounts that they have less the cash they need to complete the purchase, and then take that remaining amount and spread it out over 360 months, or a lesser period if it's a shorter term loan like a 20-year or 15-year. But so sometimes that doesn't work out too well. With the non-QM space, many of these programs will allow us to take that remaining asset total and spread it out over 60 to 84 months, 5 to 7 years. That results in a much higher monthly income amount that we can use to calculate the debt ratio. And then, of course, there's sometimes situations where we have people that just have very unique situations in terms of how their income is being earned. You know, as it says on the screen, you know, very high commission earners, those with high debt, but also lots of income. The non-QM programs can be used for that type of profile as well. And then another very common way, or the common borrower profile for non-QM borrower is an independent contractor. You know, somebody who is being paid on a 1099 basis. So they're not officially an employee. They're working for maybe one company, but as an independent contractor. So they're getting paid without not on a W-2 basis where there's payroll tax deductions and so forth. Where instead they're getting paid on a 1099. A non-QM program will allow us to use the 1099. We don't get their tax returns, and we take an expense haircut, typically 10%, and then we can use that remaining 1099 income, calculate the monthly average, and then all we have to do is get a couple months bank statements to validate that 1099 income amount we're using is recurring as a deposit into their bank account. And in a similar fashion, by the way, speaking of bank statements and going back to the business owner, the primary way a non-QM loan is used for that self-employed borrower or business owner who shows low net income on their tax return is to get 12 or 24 months of their business or personal bank statements and then calculate a monthly average of deposits from business activity into those accounts, and then take an expense ratio against that, and then use that resulting amount as a way to arrive at a monthly income amount to calculate the debt ratio. And then lastly, I would say the other big component of a non-QM borrower is what we call ITIN borrowers. These are borrowers who do not have a Social Security number. So the non-QM space will serve that kind of borrower who does not have a Social Security number, but they have a taxpayer identification number. That's what an ITIN is. And we can use the non-QM programs to serve this kind of borrower. And as a result, all of these different profiles that don't fit that kind of classic core W-2 wage earner, all of these type of profiles can be served by the non-QM borrower. And it's important to be able to do that, because otherwise, this is it's a relatively good sized group of people who otherwise would be left out of the ability to buy a home or finance a home purchase at all. And so the non-QM space has allowed them to still participate in getting home ownership.
Oh, Art, I think of that second one, freelancers and gig workers. I mean, 10 years ago, those were really not words in our vocabulary that we used very much. And so it's interesting that it has broadened to allow that to happen. I thought about the independent contractors. I thought that's where it was going to fall, but they actually have their own category. That's pretty interesting.
Yeah, exactly right. And now, mention this is, like I said, it's a niche segment of the market. In fact, I'll tell you a couple of interesting numbers. The total residential U.S. mortgage originations in 2024 is estimated to be about 1.79 trillion. It's a pretty big number.
Yeah.
The non-QM segment of that amount, any guess on what you think it might be in terms of a percentage?
Gosh, I'm thinking like 10, 15%.
That'd be great, but it's not that high.
Oh, really?
Yeah, in fact, in 2020, it was about 3%.
Oh, geez. Okay.
From 2022 to 2024, about 5%. So, for example, in 2024, the non QM segment of total US mortgage originations was about 90 billion.
Oh, that's still a lot of money.
Still a lot of money, but compared to 1.79 trillion, it's about 5%. Now, for 2025, it's projected that the non QM component of the US mortgage industry will increase to about 8% of the
Wow.
total. Um, Now, the total U.S. residential mortgage originations for 25 is also projected to increase from about 1.79 to about 2.2 trillion, which I'm a little skeptical on that. Things have gotten a little better, a little busier in the mortgage arena, but as I told you last week, you know, as according to the Mortgage Bankers Association, mortgage applications in the current period are about 20% of what they were in 2020, 2021. So I'm a little skeptical that we're going to see that much growth in total U.S. residential mortgage originations for 2025. I hope it proves to be true. But nonetheless, even with that, 8%, that's a pretty healthy increase from 5% in 2024 for this type of borrower profile. And it bears out by just what goes on day to day in the industry. We're mortgage brokers. And I got to tell you, despite the fact that the non-QM space, to use that popular term, is only a 5 to 8% share of the total, you would be amazed how much contact I get from lenders, wholesale lenders, who are in this space trying to drum up business. I mean, I get emails and text messages and phone calls all day, every day from lenders who are peddling. I shouldn't say peddling, I mean, who are promoting this kind of product. Again, it serves a real need. It does help folks. But sometimes I wonder about the amount of lenders who are participating in this segment. And when you consider the actual size of the segment, it seems like there's a whole lot of companies out there chasing a very, very small piece of the pie. And you kind of wonder, well, why are they doing that? Well, frankly, and we'll get into that probably here in just a bit, this type of loan program, these kinds of loans are highly profitable to the lenders, much more so than conforming loans. And so, even though they are a very small piece of the pie overall, wholesale mortgage lenders in general are really going after this in a very big, aggressive way.
Wow. Well, now that we understand who are non-QM borrowers, what kind of challenges they might face? I mean, do they have to have more money down? Do they have to have high credit scores? What kind of things do they have to do that maybe a W-2 would not have to do? Or is there any difference at all, Art?
Well, no, there is some differences. One thing I will tell people is the non-QM space should not be construed by anybody who's in any one of those borrower profiles. You don't want to assume that the non-QM program options are necessarily going to help you if you're what I would call credit score challenged. um, and of course, what I mean by that, if you are on the lower end of the scale as to credit score, non-QM is not necessarily going to help you. With most all non-QM programs, the minimum credit scores required are oftentimes higher than conforming loans. Don't forget Fannie Mae, Freddie Mac loans. You can be as low as 620 on qualifying credit score. FHA, you can be as low as 500 on credit score. VA, typically you can be as low as 580. Some lenders will go down to 550. Non-QM, not so. With a non-QM loan program, almost all of these different types I just mentioned, the minimum credit score, in some cases, you can see as low as 640. With some of them, it's only 660, and with others, it's only 680. So the non-QM space is not going to help you a great deal or at all if you're below those credit score minimums. So I want people to realize This is not today's version of what used to be called subprime lending. Back again, I keep talking about before the crash. Part of what contributed to the crash, many people believe, is back in the early 2000s, subprime lending was kind of similar to non-QM. It was really actually a relatively small piece of the total market, but a bunch of lenders were all over that space. Why? Because it was much more profitable business for those lenders. It would be called subprime or alt A lending, alternative A lending, or A minus lending. Those programs did allow pretty low credit scores. I can remember doing no down payment, 80-20, first and second mortgage combined to equal 100% loan to value, and you could get a loan with a 580 credit score. The non-QM space is not like that. So you do have to have still a relatively decent credit score. The other thing is the non-QM space is not going to be your option if you're only able to come up with 3 or 5% down, probably even 10% down. It's not going to be the case. There's a limited amount of that will go to 90, 10% down. I would say most are more like 15 to 20% down, as it shows on the screen. So non-QM loans in general are going to feature a higher down payment requirement than the conforming loans, Fannie, Freddie, and certainly higher than the government insured or guaranteed loans like FHA and VA. That's for sure.
Are these requirements? And I'll put up the next, because you already mentioned about the credit score.
Right.
Are these because the lenders are seeing these people as higher risk, so they're having to pay more? I mean, they're putting a little more skin in the game.
Well, exactly right. The non-QM loans in general are considered what we call in the industry, the vernacular is low doc loans. The lender is relying on less documentation of your income in order to make the loan to you. Now, low doc's kind of an interesting term depending on which one of these non-QM loans we're talking about. And what I mean by that, probably the two most popular, I would say, non-QM programs are the bank statement program or DSCR. Now, on the bank statement program, which again is usually going to be provided to business owners, self-employed borrowers, it's kind of funny to call it a low doc program when you have to give 12 to 24 months of your bank statements. That's a lot of documentation, right? Why are we calling it low doc when you have to give them 24 months bank statements, and if each statement's got 10 or 12 pages, I mean, by the end of the loan being processed and closed, I mean, the loan file could be this thick. Whereas a couple of years tax returns, a lot less documentation, right? Well, of course, what we're referring to there is not just the number of pages of documents, but how much income information do those documents provide. So, non-QM loans are considered low doc loans. And so it's just fundamental logic, right? If you're going to provide less documentation of income to the lender, they may still be willing to give you the loan, but they have to account for that risk, because there is going to be more risk to the lender if you're not able to show tax returns or W-2s and pay stubs that show enough income to qualify for the debt ratio. That additional risk has to be priced into the loan. And so obviously that means a couple things. Number one, you're definitely almost always going to be looking at a higher rate than a conforming loan, particularly if we're talking compared to an FHA VA, because FHA VA is generally always going to be better than conforming conventional. So, non-conforming loans, you're definitely going to have a higher rate involved. And then you're also, as we just commented on, the down payment requirement's not going to be 3 or 5. I would say in general, it's going to be 15 or more. And that 15 could go to even 30 or 40, depending on where you're at in terms of that credit score range. If you're at 640 or 660 and you need a non-QM loan to document your income, 15 or 20% down, 85 or 80% loan to value is not going to happen. You're probably looking at 65, 70, 65, even 60 on your loan to value. So you're going to have to provide a much higher down payment.
What about with do they have to have anything else, like, how do they prove their income? I see you say bank statements. Anything else?
Well, it's interesting. Some of the programs out there for documentation of income, you know, can almost sound a little scary. Um, we mentioned the 1099s. I think that's actually a pretty good approach. I mean, 1099 income, I think, is a good indication of income. Yeah, you have to take a little bit of a haircut off of the total amount before calculating a monthly average. But if you can believe it, there's a couple of programs out there in this non-QM space that one is called P&L only, which means a business owner can provide simply a unaudited profit and loss statement and use that as their qualifying income. And now, the, the way that's accounted for in the file being underwritten, the lender is going to look at that profit and loss statement. And of course, you might think to yourself, well, that's interesting. They're going to prepare a profit and loss to show a higher net income and probably enough to, qualify for the loan based on debt ratio. Yeah, that's probably true. But what the lender tries to do to safeguard any, misrepresentation of the numbers is they'll still support that P&L with a few months bank statements, like 2 or 3 months bank statements, to see that the business is generating business deposit activity to support what's on the P&L. And then here's another interesting thing, program under the non-QM space, what's called VOE only, verification of employment only. Now, in the industry, VOE is a standard form used for conventional conforming as well as FHA, VA. It's a form that's sent to the employer, and they fill out, current income for the current year, the past 2 years. It'll break down, salary, bonus, commission, etc. And then that information is used by the lender to calculate a stable recurring monthly income to calculate a debt ratio. Well, in the non-QM space, if you can believe it, some of these programs allow the borrower to get approved simply by getting a VOE only and nothing else. No pay stubs, no W-2s. That can be a little tricky, as you might well imagine. There are some rules involved with, where does that VOE come from? Can the borrower fill that out themselves? Absolutely not. Even the borrower, saying, hey, send it to my company, I'll have my direct supervisor fill it out. A lot of times that's not okay either. Usually it's got to be filled out by the payroll department or HR if the company is big enough to have those departments. Where the VOE only comes in most of the time is somebody working for a very small business, where maybe the business owner does their own payroll themselves, or maybe they're paid, with handwritten pay stubs and so forth. So the business owner is relied upon to fill out that form, and hopefully they're going to fill it out accurately enough that it's not going to cause a problem for the borrower later on when they get that loan. And hopefully they won't have any trouble meeting the payment if they got that loan based on what was put on the VOE. So yeah, some of these documentation options can be very, very minimal to get that loan. But again, that's why the rate is going to be higher, and that's why the down payment's going to be higher, to protect that lender against that higher rate of default risk from having less documentation to make the underwriting decision.
I just want to, before I go to the next little piece is, so you're saying with the VOE or P&L, these are the only documents, not in combination with the other documents.
Correct.
It could be, wow, that's okay. So it sounds like they're trying to make accommodations to get these people loans. But again, they're paying higher interest rates and requiring a higher down payment. I suspect the less they have to come up with, the more those two items tend to go up, or am I over?
No, I think that's generally right. Now, there'll be a little bit of a combination of documentation. Like, for example, I mentioned earlier, you provide your 1099 for 2024, but you may be asked by the lender to provide most recent 2 months bank statements, or maybe 3 months, to show that your deposit activity from business transactions into your account are supported by, or at least a very high percentage of what the monthly average was from the 1099 you provided for the previous year. But it's maybe 2 or 3 months bank statements instead of 12 or 24. Same with the P&L only. You might have to provide 2 or 3 months bank statements to support that P&L for the previous year, but again, not 12 or 24. So there's a little bit of that, combination of documentation options to make it work. If you're doing a debt service coverage ratio for a real estate investor, Um, there's none of that because employment's um, blank on the application. Employment income is blank on the application. Sure, you have to provide a couple months bank statements to support the liquid assets you have that you're going to use for the down payment and closing costs if you're buying the home. Plus the fact when you're when you're a real estate investor, if you have multiple rental properties, you have to provide those couple months bank statements to support that you have enough cash reserves to support all those homes, particularly if one of them goes vacant for some reason. So that's pretty much how it works in terms of the documentation.
Gotcha. This next one is do non-QM buyers have challenges when it comes to things um, like getting HELOCs? If they already own the home and now there's still these people, do they have challenges with this, or have they kind of already crossed that hurdle once and now they're in good shape?
No. There's a good point. Home equity lines generally are not going to be an option for somebody who needs a non-QM documentation approach.
Mm.
There is a little bit of home equity lending, both HELOCs and fixed rate seconds, that will be available for this borrower profile using bank statements, the 12 or 24 months. But that home equity line of credit or home equity loan option is very limited within the non-QM space. Not all non-QM lenders offer that. So yeah, if you're a non-QM borrower profile, you're going to have very limited availability for a home equity line of credit.
What about those people who, okay, you've gotten them a loan and now, 2 years later or a period of time later, the rates seem to drop and they come back and you said, hey, can we refinance our home?
That depends. I mean, in some cases, if we had to use a non-QM approach a couple of years ago when they first bought their home, depending on how their employment situation is now, if it's changed at all, where maybe more incomes are being reported through the traditional means of a tax return, it may be possible to convert them to a conforming loan for the refi. Otherwise, it could be a case where they have the need to use a non-QM loan again to get the refinance done. And then it's all about where are the rates now for the refi compared to where were the rates earlier, a year or 2 years ago when they first got that non-QM loan for the purchase.
Do you still use that? Hey, there's a certain amount of space between what my rate is now and what the rate has changed to make it viable or make it make sense to have a refi? Does that still play in with this?
Yes and no. I mean, in the old days, when I first got in the business, it used to be pretty much standard. Oh, you have to have at least a 1% reduction in rate to make it worthwhile. I think more recently that's not necessarily the best rule. I mean, it really depends on what are your non-recurring costs, what is the improvement in your monthly payment, and then just do the calculation of the recapture period. If a refi is going to cost you, $4,000 in non-recurring closing costs, one-time fee-based costs, and if your improvement in payment is such that you can recoup that closing cost amount in, say, 6 months, a year and a half, even 2 years, I would argue that's probably worth it. So I really think that's the way you want to evaluate when is the right time to do the refi. What's the non-recurring cost? What's the monthly payment savings? And then calculate that recapture period.
What about people who are, we've got such a big segment of people now moving into their retirement. They've got equity in their homes. What about reverse mortgages?
Yeah, unfortunately, reverse mortgages generally are not part of the non-QM space. Now, reverse mortgages, though, in general, especially the core product, the FHA HECM product, you're not really qualified based on the traditional debt ratio anyway. But that's not to say that you're basically going to be treated like a non-QM borrower. It's just a whole different approach.
Okay.
The lender is going to evaluate your monthly income. They're going to evaluate your assets, but that's more about determining if you have enough income and assets that you can maintain the property related expenses for the home, taxes, insurance, HOA dues if applicable, maintenance and repairs. If you have enough income, have enough assets to meet those ongoing obligations after getting the reverse mortgage, that's really how you're going to be looked at. It's not really the same as a non-QM approach.
So you really move out of that non-QM position into, hey, you're a homeowner, you have this equity, and now using the reverse mortgage criteria, they don't even ask about those other things, do they?
Right. Exactly.
Gotcha.
And I'll let you ask a question, and then I'll make a comment about the refinancing.
Well, I just want to know if you have any recent examples of that and how it goes, and is it more challenging? Is it easier? are the people coming in already knowing, hey, I know it's going to be challenging for me, but I'm ready?
Well, I've got a really good current example.
Okay.
I arranged a non-QM loan for a buyer of a home about almost a year and a half ago. In fact, it was late summer, early fall of 23. And if you recall, at that time, rates got pretty high. We were getting a 10-year bond yield close to 5%. And that was kind of a high peak over the last couple of years. And this was a person who was working for a company. And the job she had as a physical therapist, she was working through this company solely for one school district. Well, she figured out she could make more money if she left the company she worked for and kept working for the school district directly, independently, basically self-employed, independent contractor. So at the time, having just done that, we couldn't do a conforming loan. She didn't meet the core requirement of at least 2 years in the business or at least 1 year if you had a history in that industry. So we had to use a non-QM approach. So we used a 1099 program approach. Got her approved. Her and her husband closed on the loan, but they got a rate of 8.5%.
Oh boy.
So then we talked just about a month ago. She let me know she had filed her tax return for 24 as a self-employed person, thinking that would help her get a conforming loan. So we looked at it. Back to the other common problem with self-employed borrower. She had an S corp, very high gross revenue, did pay herself about a $50,000 salary, but her net income was pretty low. So we still had the problem of a non-QM or not being able to qualify for a conforming loan on debt ratio because the net income was too low. So then what we're doing, I could still get her a refi done using the bank statement program, 12 months business statements. And we can't get her, a conforming loan at 6 3/8 as we had in our rate grid, but I'm getting her 699 using the bank statement program, and they're going to save over $500 a month in their mortgage payment.
That's a big
So
difference.
this is a good example of how we use a non-QM program to help them buy the house, and now we're now using another non-QM program to help them refi for a lower rate.
That's great. That's great news, especially for them. That $6,000 a year in savings. That's a big difference.
Yep.
Well, Art, thank you so much, because as we talk about this, yes, it's 5%, but expected to go to 8%. That's that is a 60% increase in the volume from this particular segment.
Right.
As you say, it's not like the conforming loans, but there are a lot of people out there that feel like, hey, they need to be served. And obviously, because you just gave us an example of that, are all lenders non-QM lenders, or is it somebody like you who has that ability?
Very good question, and the answer to that is no. No, not all lenders do non-QM. In fact, most major banks, if you go to Chase and B of A's and Wells Fargo's, they generally don't do that kind of stuff. U.S. Bank, they don't do non-QM. Even most mortgage banking companies, like the big ones, like Loan Depot and so forth, they don't do non-QM to speak of. I would argue that the non-QM segment of the mortgage industry is probably dominated by mortgage brokers like us. As a mortgage broker, we have access to just about any loan program out there, conforming, conventional, FHA, VA, USDA, jumbo loans, but then all of this non-QM product as well. That's why mortgage brokers are now a very good percentage of the total mortgage origination industry. We account for more than 25% of total mortgage originations in the country. And that's partly because we provide this wide range of product choices to meet just about every borrower's need.
I like that. You're kind of like fixing the Rubik Cube for someone out there. That's pretty good.
Yeah.
Well, I put your information on the screen, 760-969-5023. And one last question. I'm sorry, this is going to come from left field. It comes to lender paid compensation. Is it the same process as we've talked about in the past?
Yes and no. With some non-QM lenders, when we sign up with them, and I'm talking about non-QM wholesale lenders, some of them do not allow or offer lender paid comp. And that's a good point to bring up. So what that means is if we're going to originate a non-QM loan with some of these lenders, depending on who it is, we aren't going to get paid by the lender. We are going to get paid by the borrower. But and this is unheard of in the non-QM space because it is considered a very profitable segment. And not only the lenders make a lot of money, but brokers look at it as a way to make a lot of money. Most mortgage brokers will not do what we do. If I'm doing a non-QM loan with a lender who won't pay us lender paid comp, I will be paid by the borrower, but I'm still going to only ask for 1%.
Wow.
Many mortgage brokers think I'm insane to do that. They're going to charge that borrower 1.5%, 2% or more sometimes. So in this case, we're a great option for non-QM borrowers to at least get a quote from, because I would argue we're going to be very competitive compared to just about any other mortgage broker out there. And then for the lender paid for the mortgage, I'm sorry, for the non-QM wholesale lenders who do pay lender paid comp, our 1% lender paid comp standard makes us highly competitive against other mortgage brokers for this type of mortgage product type.
Seems like a no-brainer for the non-QM people who are already going to pay higher interest rates and higher down payments, or expect to have higher down payments. So that's it's very good to know that you are holding steady to the 1%, whether we pay it as the borrower or the lender pays it out. So thank you very much, Art. Great information today. Any last thoughts before I dive out of here today and let you wrap up the show?
No, again, given we covered this subject, I would encourage anybody out there who's watching or listening, whether you need it yourself or if you know somebody that meets any of these borrower profiles we've talked about, please have them give me a call. I'd love to have a conversation with them. If they're looking to buy a home or even refinancing a home, I can give them some good ideas about some of these options so that we can find something that's going to work for them.
Great. Thank you, Art.
Okay. Thank you, Jeff. I want to thank everyone for watching and listening to this week's Mortgage Minute. Have a great weekend. Next week, of course, will be an exciting week. We got St. Patrick's Day coming up on Monday. And of course, I'm looking forward to the opening week of March Madness, the college basketball tournament. So in the meantime, have a great weekend, and we'll see you next week on the next edition of the Mortgage Minute. My name is Art Alvarez with MortgageWorks, where we have the answers and they're on the house. So long. Take care.